The stock market has had a very strong start to the year, with the Nasdaq up over 10%. But could we be near the end of the bull run? Hey everyone, it's Jonathan here. And let's discuss what's the biggest risk to the stock market in 2023, according to the suits at least. And that risk is equity risk premiums. And pretty much what equity risk premium is, it's the difference between the return that you get if you buy treasuries versus the return that you'd get buying stocks. So typically speaking, when you buy stocks, you expect to get anywhere from about a 7 to 10% rate of return. But with the Fed going on their most aggressive rate hike in history, we have started to see treasury yields move up, with the 2-year treasury somewhere around 5% right now, putting treasuries into direct competition with stocks, making the ideal of buying stocks less attractive to investors. This is Morgan Stanley's point of view on the market. So they believe that the US economy may be able to avoid a recession, but they also do believe that the Fed pivot this year is off the table, and that will most likely come in 2024. And this does make sense given the fact that we have started to see the possibility of more rate hikes than what the market is currently pricing in, given some of the hot inflation reports that we have recently gotten. And this recent rally that we've seen in the stock market has led to the most expensive S&P 500 equity risk premiums that we've seen since 2007, according to Morgan Stanley. And in their eyes, that does create a bad risk-reward scenario when it comes to investing in equities, or stocks, I should say. And when you combine this with the fact that earnings expectations are about 10 to 20% too high compared to Morgan Stanley's estimates, they predict that the S&P 500 will collapse 26% in 2023. And they're not the only suits saying this as well. JP Morgan also echoed Morgan Stanley's bearishness, and they say that the Fed's policy lags about 1 to 2 years after it goes into effect. And we will see more pain in the market until the Fed finally does decide to U-turn, which historically the Fed's U-turn does highlight the bottom of the stock market. And they believe that the Fed won't pivot until they start to see more negative macroeconomic data. And they believe that that probably will not come until very late in the second half of 2023. So they believe that right now, currently, Q1 will be the highest point of the stock market this entire year. And Bank of America follows suit by saying that they believe that the strong economic data that we've recently received will lead to the Fed to keep rates higher for longer, leading to this no landing scenario, which is pretty much when you have a soft landing, that's when inflation comes down, but you don't have a recession. And then a hard landing is when you have inflation come down, but you do have a recession. And the no landing scenarios where you have high inflation, also with a strong economy, and lead into an eventual hard landing at some point once something breaks in the economy. And this is Bank of America's opinion that there is a small possibility of us seeing that in the second half of 2023. So what are my thoughts on all of this? So when it comes to January inflation data, I believe that in January, you usually get a lot of different adjustments for various different inflation and jobs reports. And I think that that could really skew what the numbers that we do get. So I do think in February, we'll probably get much softer numbers. Even with all that craziness of January's report, we did see year over year inflation continue to trend down that it has been on over the past couple of months. So I do strongly believe that in February, we'll also get a report that will continue to show that downtrend as well. To some degree, you can almost say I'm blowing off the inflation data from January. I don't think that we will get a rebound, but if we do get a rebound, then it may create a better opportunity to buy stocks. Now, when it comes to that, you might be thinking, okay, well then, why should I buy stocks now if I could just buy stocks later and they'll possibly be down? Well, at the end of the day, it is a possibility, but it's not a guarantee. And at least in my opinion, I feel like a lot of the stocks that we are seeing in the market right now are priced at pretty competitive valuations. So that's just my take on it. That's not personal advice for you. So when it comes to equity risk premiums, I do agree that equation is definitely favoring treasuries instead of stocks. And I think that this will affect the market overall, given the fact that most of the market movers are big institutions that have a lot of money to invest. When it comes to personal investors, and again, not personal financial advice, even though I am a financial advisor, I can't personally advise you on how to manage your portfolio. I think it really just depends on your investing style. If you're somebody who's probably going to retire very soon, then it might make sense to pick up some treasuries and take that 4 or 5% yield they get on them. But if you're somebody who's still working and you still plan to be working for a while, it might not make sense to worry about treasuries and to really focus on picking up equities at very good prices. So in that way, once the market does move up, especially if you have a very long time horizon, you'll probably do very well if you do buy companies that have pricing power and that have the ability to withstand a recession. Maybe not so much of the staples. The staples had a really strong outing in 2022, but I don't know about moving forward if they're really going to do as well as they have done. But that's just my take. So I'd like to thank you all so much for watching. As always, please like, share, and subscribe. And I'll see you in the next video. Peace.